we have is short-term notes receivables. Okay. Now, we had accounts receivable. And if you remember when we talked about accounts payable and notes payable, we had those two types of liability. And when you asked, I said notes payable, the difference between them and the accounts receivable is they have relatively bigger amount. Okay. They are longer in time payment, and they bear interest. Okay. So sometimes this happens to the accounts receivable. Okay, somebody owes me money. They say, okay, you know what? I need more time. Okay, so instead of just paying within the 30 days, I want 90 days. Okay, and I'll pay you 5% interest on it. Okay, so that accounts receivable will be what? Note receivable. Most of the cases, okay, we either issue it or convert accounts receivable into notes receivable. Okay, so promissory note, written promise to pay a specific amount of money, either on demand or definite future date. Okay, the short-term note receivable, promissory note that becomes due within 12 months. That's why it's called short-term. Remember, like when we classified the assets, we have current assets, we have fixed assets. What was the thing is that within the period of time when we had the fixed asset, we had depreciation on the fixed asset. We said, because these help me for more than one financial period, they helped me in 10, 15 years. So I distributed their cost over the period of time that they served me. Okay, so we call them short-term because they are due within the operating cycle, within the 12 months. Okay, usually they have interest. Okay, and it's on annual basis. Okay, so in the questions it says a month, like you see some cases it says for the month of May, so that I would call it 1/12. But normally, most of the times, if it says 90 days, then 90/365. This is how we calculate. This is the duration of it. Okay, when it says on annual basis, then that's my interest, whatever the interest is, the principal by the interest by how many days over 365. We see we need to calculate this until maturity date. So always we take how many days over the 365. Okay. So interest is calculated as follows, the way I just written it. Principal of the note, so it's 10,000 at 5%. Okay. Time 90 days. Okay. That would give me the interest that should be paid for this principal. Okay. So,
Bradley, can I see that again, please?
absolutely, but yeah.
Okay, it's fine now. Thank you.
You're welcome. So, TechCom receives 1,000, 90 days, 6% promissory note at the time of a sale. Okay? So what am I recording? See? I see it says note, just like that, right? When we said a note was written, promissory note was given. See here, it says a promissory note. Here it says receives. There we have written promissory note. That's notes payable. This is what notes receivable. It's not accounts receivable. It's notes receivable. Okay? So what am I entering? Same thing. If I receive cash, I would write cash. If it's not a notes receivable, the way we used to get it, I would say accounts receivable at 1,000. All from sales. I sold 1,000 worth of merchandise. I received cash for it. No, I did not receive cash. It's accounts receivable. No, it's not accounts receivable. It's not receivable. Okay, so that's the entry of it. Okay, just like the accounts receivable, it's called notes receivable. And then we have to deal with the interest I'm receiving from. Okay. Pay attention here. This is what you're going to do. Most of the assignments on this part, you have to do this calculation for one note, sometimes for more than one note, and you add them together, etc. So pay attention here so you're not confused there, and you keep on, oh, okay, I did not do this. I did not calculate this. Pay attention here. This is a special case. A normal case is that this is done in, let's say, May 13, right? So when it comes to June, July, August, okay, 13 or 14, after 90 days, whatever we need to calculate, days, don't assume them, okay? Calculate by your hand or a calendar and say this is 13, how many days left until the end of May, okay? 18 days, all June, 30 days, and then how many days are left until 31 in July, and then how many days still to make it 90 days. Okay, you have to calculate exactly how many days between May 13, 90 days. So let's assume it's August 11th. May actually will be 10th probably because we have 3 months of 31 days, right? So on August 10, right, this is will due, right? This is 90 days between this date and this date. Okay, this is my 90 days. On the date when it is due, I will receive cash. The notes receivable will be credit, so I can cancel it, okay? And I will add to it what the interest earned. Now, this is like, what's in here? I said this is the normal case. This is within the year. This is between May and August, right? So nothing would happen in the middle. Nothing will happen in the middle between the issuance of the note and the maturity of the note. Okay? Nothing will happen. In the other example, what's the difference in the other example that we're going to work on? What's happening here? This is actually December 16, right? So this is 16th of December. And it is what? 60 days. So what would happen in the middle in here? This will be December 31st, which means the year will end here. And then the maturity comes in here. Make sense? This is 60 days. It will be somewhere in February, maybe Feb 10 or 12 or whatever, right? So I have to do an entry here to record the interest earned. There's an interest earned between the 16th and the 31st. For that amount, okay? For what? For so and so days. This interest I earned, it's not paid yet to me because the guys will pay me when? The guys will pay me so I have to record this because this is a due and I did not get it. This is earned. Nobody's paying me at this time. I will be paid in here. When the note is matured, I will receive all the principal plus the interest. Okay? But in here, according to GAAP, remember, we have to record the interest when it is earned, whether it's received or not. This interest is counted for this year, whatever it is, even if it's $10, it's counted for here. I should not count, enter it, and it will not show in this year, regardless. Okay, so there is an additional entry only because of this. Okay, so in here it says on December 16th, TechCom receives, look, pay attention here, 3,000, 60 days, 6% promissory note, and 1,000 cash to settle 4,000 past due account. So what did I have? Past due account means there was an accounts receivable of 4,000. Okay, they came to me saying, you know what, we only have 1,000 now, give you the 1,000 and we'll give you a note for 60 days. We'll pay you the rest of 3,000 at 6%. Okay, so I received cash. They're giving me the cash now, and they are giving me a note receivable of 3,000 in return of what? How much they owed me in general, the accounts receivable. Okay, so basically it was accounts receivable 4,000, sales 4,000. Now I'm canceling this accounts receivable, the accounts, see the account as accounts receivable, it was 4,000. Now I'm canceling it, 4,000. Okay, I'm receiving 1,000 cash from it, and I'm opening notes receivable for them. Okay, so this can be just said we received 3,000 whatever promissory note without this. But this is a case when we have already accounts receivable, and I'm receiving opposite to it, notes receivable. I'm converting this accounts receivable into, they can just say, okay, we don't even have 1,000. We'll just give you a note receivable for 4,000. Same thing. I'm converting the accounts receivable into notes receivable. This happens when? This happened when I got the note, when I got this settlement of this account. Like I said, this can be just 3,000. They don't owe me 4,000. So in here, there is no 1,000. In here, there is 3,000, whatever. So whatever it is, accounts receivable, how they are settling it, paying part of it, or the whole thing is converted to notes receivable. So this is recorded on the issuance of the note. This is recorded, this entry is on December 16. Okay? Now, December 31st, 15 days after the note is issued, an approval for interest earned on the note is made. This is what I explained. I said this is a case whenever it tells you that the year ends, even if it's not December we're talking, even the example I gave you, I said, what was it, 13 May? Okay, if the year ends on June 30th, because their year is from July 1st until June 30th, if this is the end of the year, I do the same thing. So if the end of the year happens during the note, I must record this. Okay? I must record the earned interest. Okay? Whether my year starts January 1st until December 31st, or my year starts any day and ends in any date. If it's within the time of the note, then I have to do this entry. So on December 31st, the 15 days in the note issuance, I have to record the interest. Okay? So I'm recording this. What do I call it? Interest receivable. It's interest I shall receive. Make sense? This much. As what? As interest revenue. I made interest. You see, I'm recording that I made this much of interest in this year. See, on the 31st, I'm recording making money. I have to record it for this year. That's why I'm doing this entry on December 31st. Okay? And this is part of the interest I shall receive when the note is matures. Okay? So, interest receivable, 740. Interest revenue, 740. Where did that come from? The principal by the interest rate by 15 days between 16th of December until 31st. See how I write it? 15 over 365. Calculating this, gave me 740. This you do whenever the year ends in the middle of the note. This happens in the year end. If there is no year end there, you don't do anything in here. You just issue the note and receive the money and the interest in here. Anything in here, if this happens anytime when the year ends, financial year, then you have to do this entry. Okay? So this was recorded. This is just recorded. I'm not receiving any money. I'm just recording that I made revenue, and this is interest receivable. This amount should be received when they pay me in February. February 14, 16 days note matures. Matures means it is due. So I'm receiving cash. Now cash amount, you leave it until you do all these, you add them, that's your cash amount. I don't know this until I do these. Okay? So your entry is cash, I'm receiving cash. That's my debit. And these are my credit. Okay? What is my credit? First of all, the amount of the note receivable. Note receivable here, remember, was 3,000. When we issued the note, when we received it, now I'm making it credit, so there is no more note receivable. So that's 3,000. Okay? Here is my interest receivable. Here it was debit, I'm making it credit, so no more interest receivable. It will be received now. I'm receiving cash for it. So interest receivable, okay, it was 740. I'm making 740 here. That one is also closed. So here, notes receivable, closed. Accounts, interest receivable, closed. And here I made this much of interest. And now I'm making how much of interest? This much. For what? For the days between January 1st and February 14th. This is my interest. Now this, you can calculate in two methods. What he did here, which I wouldn't do, right? I would do this only if I don't have this entry done, right? If there is no end of year. The whole principle by the amount, the interest rate and the total days. Here, I'm calculating for what? I'm calculating, like I said, the interest between January 1st and February 14th. My entry here was for how many days? My interest receivable, 15 days, correct? So that 15 days was in December. How many days I have the total in here? 60 days for the note receivable, right? So how many days between January 1st and February 14th? I have 45 days. I got 15 days of it. This is my 15 days. So if I multiply 3,000 by the 6% by 45 over 365, I will get that number right away. What he did, he calculated the total 60 days, which came to 29.59, subtracted the 740 for 15 days. This is the rest. So this is same. You want to do it right away by 45 days, or you calculate the 60 days, you find the total interest, you calculated this for it, this is the rest. It's clear, guys? So I have interest receivable, I'm getting now. I have interest revenue for these 45 days. I have the principal here, add them all together. This is how much cash I'm receiving from my customer. If you add these two, that's the interest calculated for all 60 days. This is for the 15 days, and this is for the 45 days. Capiche?